Welcome back to the Deep Dive. Today, we're opening up quite a collection of sources, financial reports, tech breakdowns, analyst notes, all focused on Bloom Energy, ticker BE.
Right. And they're, really central in the clean energy conversation. But lately, their name keeps popping up alongside, well, AI, artificial intelligence.
Exactly. So our mission today, let's try and cut through the noise pretty quickly. We want to unpack what Bloom Energy actually sells, why the stock's been so, let's say, dynamic recently, and figure out what specific things are making analysts think this company is basically critical infrastructure for the next waves of computing. Is there really a hidden gem angle here, or is it just another power company?
Well, to start, Bloom Energy is a U.S. company, been around a while, founded 2001 out in San Jose.
Yeah.
Their whole focus is power generation, but specifically decentralized power generation.
Yeah.
They're not about waiting for the big grid upgrades. They want power right where you need it.
On-site power.
Precisely. And they're operating at a pretty massive scale now. The sources mention revenue around, USD 1.47 billion by 2024?
Okay, 1.47 billion. So let's start right there. Most people hear clean energy, they picture, huge wind turbines or solar farms stretching for miles.
Right.
Bloom's doing something different.
Yeah.
So what is the core tech they're selling? Why is it supposed to be such a game changer?
Okay, so the product itself is called the Bloom Energy Server, and the engine inside, the core tech, is the solid oxide fuel cell, SOFC.
SOFC.
Right.
And the absolute key difference here, the thing to grasp, is they generate electricity right there on site through a chemical process, not combustion, no burning.
Okay, so less like a typical generator, more like a continuous battery?
That's a good way to think about it, yeah. They take fuel, could be natural gas now, or biogas, or looking ahead, hydrogen, and use it in an electrochemical reaction to make electricity. Cleaner, quieter.
And this non-combustion thing, what's the big advantage? Well, a few things. The systems are modular, so you can scale them. They're highly efficient. And crucially, you can put them right next door to whatever needs the power. A hospital, factory, or, and this is key today, a data center.
Right, the data centers.
Yeah.
And that modular, put-it-anywhere capability, that's the distributed generation idea.
Exactly.
And why this matters to you listening is that it means potentially less dependency on the big centralized power grid, which can be, well, fragile sometimes. If you can make clean, reliable power right on your own property, that solves a huge operational headache, doesn't it?
It really does. They're tackling reliability first, which then enables the sustainability piece and the fact that they can use different fuels, that flexibility, that's critical. They're kind of hedging their bets on what the dominant clean fuel will be down the road. Natural gas today, maybe hydrogen tomorrow.
That flexibility is interesting from a tech standpoint, but does it translate financially? Can this approach actually support the kind of massive growth they seem to be aiming for? Is the balance sheet healthy?
Well, it looks like the financial picture is getting stronger. You mentioned the stock's volatility, and it's still a growth story, so expect bumps. Yeah. But recently, there's been a strong move up, hit a 52-week high, I think. That suggests the market is starting to see them execute.
Okay, so what metrics are showing that?
Revenue growth looks solid. Sources pointed to Q2 2025 revenue around, $401 million. That's up nearly 20% year over year.
Almost 20%.
And importantly, gross margins are improving, ticking up to around 28.2%. For a company making big, complex hardware like this, that margin improvement is a really good sign. It means they're getting more efficient as they ramp up production.
And stability, liquidity, debt.
Looks pretty healthy there, too. Their service business, maintaining the servers they've already installed that's consistently profitable, gives them a nice recurring revenue stream.
Good point.
And liquidity-wise, their current ratio is about 3.44, which, for anyone not familiar, basically compares short-term assets to short-term debts. Yeah. A number like 3.44 is very strong, shows they can easily cover their immediate bills. Plus, they did some smart refinancing of convertible notes recently, pushing their debt further out, buys them breathing room to invest in growth.
Okay, financially strengthening. Now let's pivot to the thing everyone's buzzing about, the deals. This is where Bloom maybe shifts from just being an interesting tech company to potentially a critical infrastructure player, right?
Absolutely.
Tell us about these partnerships connecting Bloom to, well, the biggest power hog on the planet right now, AI.
Right. So two huge signals really jumped out from the sources. First, the deal to power Oracle's AI and cloud data centers.
Oracle. Wow.
That's a massive vote of confidence from a hyperscaler, one of the giants dealing with just insane power demands for training these huge AI models.
Okay, that's one. And the second deal. That one seemed even bigger in terms of sheer scale.
Definitely. The agreement with American Electric Power, AEP, a major utility. They agreed on capacity for 1 gigawatt of fuel cells.
1 gigawatt. Can you put that into perspective for us?
It's huge. Roughly speaking, 1 GW could power hundreds of thousands of homes. Or, more to the point here, it could power multiple massive AI computing clusters.
So AEP, a traditional utility, is essentially buying into Bloom's tech as part of their future planning.
That's exactly what it looks like. It signals that even the big power companies see Bloom as potentially essential for meeting future demand, especially demand that needs to come online fast.
Okay, let's connect those dots then.
Yeah.
Oracle, AEP. These deals really highlight the core problem in tech today, don't they? Getting enough reliable power quickly. Why can't they just wait for the grid to catch up?
Because AI isn't waiting. Building new substations, big traditional power plants, that takes, what, 5-7 years sometimes, maybe longer? You're battling permits, land rights, construction.
Right, the red tape.
Exactly.
Right.
Bloom's pitch is their modular systems can be permitted and installed potentially in 12 to 18 months.
Much faster, way faster. If you need to power up a new AI cluster next quarter, that speed advantage is, well, almost priceless. Bloom is basically offering an express lane for AI infrastructure power.
That makes a lot of sense. Speed as the killer app, almost. Okay, so that's the Dan side. What about other tailwinds? It's not just tech needing power. Policy seems to be playing a big role, too.
Oh, absolutely. Policy is like a financial cushion here. There's significant government support in the U.S. for technologies like Bloom's.
Like what specifically?
Well, the sources mentioned Bloom is eligible for up to $75 million in tax credits, just for their factory in Fremont, California.
$75 million, that's real money.
It is. And it's part of that bigger push, to bring clean energy manufacturing back to the U.S., make it more secure. It directly cuts Bloom's costs for expansion.
And speaking of expansion and future-proofing, I saw notes about them looking beyond current tech, too, exploring future fuels.
Yeah, this is really interesting. They're actively positioning themselves for the hydrogen economy. Remember, their SOFCs can run on pure hydrogen.
And they're also working on advanced carbon capture tech, ways to utilize co-Euros. So it means they're setting themselves up to win whether the future grid runs on cleaner natural gas or biogas or full-on hydrogen.
So they're aligned with multiple decarbonization pathways. Smart.
Seems like it. Hedging their bets again.
And to handle all this potential demand from Oracle, AEP, whoever comes next, they're making a huge operational bet themselves, right? Doubling factory capacity.
Correct. There's an explicit plan out there. Double manufacturing capacity from 1 gigawatt to 2 gigawatt.
Oh, doubling.
It's a massive statement of confidence. They're essentially betting the farm that this demand pipeline, especially for AI, is real and justifies scaling up production that dramatically, that quickly.
Okay. Huge potential, big bets. Let's flip the coin now. Anytime you see a stock rising like this, with this much sort of speculative excitement, there've got to be significant risks. So what could actually derail this? What keeps the bears up at night, especially with that ambitious scaling plan?
Good question. The first very real headwind is margin pressure. It hits their profitability today.
How so?
Tariffs. Specifically, tariffs on components they have to import. The sources cited this as dragging down their gross margins by about 100 basis points.
A full percentage point.
Yeah, basically a 1% hit just from global trade issues. That adds up when you're trying to scale.
Okay, tariffs.
Yeah.
What else? That 2 GDW goal sounds great, but doubling factory output? That sounds incredibly difficult to pull off smoothly.
Execution is absolutely everything here. You're right, it's incredibly hard. Scaling that fast puts immense stress on the whole system.
Like what kind of stress?
Think about it. Fragile global supply chains, can they actually get all the specialized parts they need for these advanced fuel cells on time?
Right.
Then there are local permits. Getting permission to install these servers at each customer site takes time. Delays there can cascade. And even just getting the fuel itself. Is there enough natural gas pipeline capacity or eventually hydrogen right where the customer needs it? Any bottleneck there slows them down.
So lots of potential operational tripwires.
Definitely. And beyond operations, there's competition and market volatility. Bloom's a high beta stock, remember, moves around a lot.
Meaning it's riskier than the average stock.
Exactly. And they face real competition. Not just other fuel cell companies, but think about rapidly improving solar, wind, especially when paired with big utility scale batteries.
Ah, the battery tech improvements.
Right. If battery costs keep falling off a cliff, that could challenge Bloom's whole distributed model, particularly in places where getting hydrogen fuel might be difficult or expensive.
And dependence on those government incentives we talked about.
That's another risk, absolutely. Policy can change. If those tax credits dry up or regulations shift, that impacts their economics directly.
Okay, so a real mix of strong tailwinds and significant hurdles.
Yeah.
Let's talk outlook then, because the analyst forecasts seem to reflect exactly this tug of war. The range of price targets is just wild.
It really is something. We saw some analysts with 12-month targets down around $10 a share, basically saying we're skeptical they can pull off this scaling.
Okay, $10 on the low end.
But then you see others pushing way up, maybe $35 or even higher. That huge spread tells you just how much uncertainty there is. Is this a struggling hardware maker or the key to powering AI? The market can't decide.
And then there was that one really eye-popping forecast, Morgan Stanley raising their target. Wasn't it way higher?
Yeah, that one stood out. Morgan Stanley reportedly raised their target all the way to $85 a share.
$85. Okay, for you listening, that sounds almost unbelievable. What has to go absolutely perfectly for Bloom to justify a valuation like that?
Well, that $85 target is essentially betting that Bloom becomes the go-to power solution for the entire AI industry. It assumes everything goes right.
Like what?
Like the 2GW factory expansion happens flawlessly right on schedule. It assumes hydrogen becomes a major cheap fuel source relatively quickly. And critically, it assumes that Bloom's speed advantage bypassing the grid delays is so valuable that tech companies will pay a massive premium for it. It's basically betting they transition from just selling boxes to becoming a necessary utility layer for the compute infrastructure of the future.
A tall order. But you can see the logic if AI power demand truly explodes.
Right. So if we synthesize it, the bull case. It's all about that massive, unstoppable AI demand needing power now, Bloom scaling successfully to meet it, and government policies helping smooth the way.
And the bear case.
The bear case warns about intense competition, those tariff squeezing margins, and maybe most importantly, execution fumbles. If they stumble trying to double capacity, if there are delays, if costs get out of control, that could really hurt the stock.
So what's the final take from the sources? Where does Bloom Energy actually sit right now in this whole picture?
It seems Bloom is right at this fascinating intersection. You've got clean power, you've got decentralization, and you've got this critical need for AI infrastructure. Those big deals, Oracle, AEP, they're powerful proof points that something real is happening. Right. But because so much of the upside depends on them executing this massive scale up perfectly, managing costs, navigating supply chains, it's still widely viewed as, let's say, a speculative long-term play. Huge potential upside if they nail it, but also significant downside risk if things go wrong. Not necessarily a safe bet yet.
Okay, so what does this all mean for you? We've dug into the Texans, the solid oxide fuel cells, the non-combustion power. We've seen the key deals tying Bloom straight into the AI build-out. And we understand the huge stakes riding on whether they can actually execute this massive operational expansion.
It's a complex picture.
Definitely. So here's a final thought for you to chew on, something to explore further. We know Bloom relies on both the demand for its distributed power and on policy support. So which factor do you think will ultimately be more critical to their success over the next, say, 3 to 5 years? Is it the government help, like those $75 million in tax credits? Or is it purely their operational ability to actually scale that factory smoothly, from 1 GW to 2 GW policy cushion or boots on the ground execution? Which one holds the key?
Interesting question.
Something to think about. Thanks for diving deep with us today.